What's up, guys? I'm Michael Key, and today I'm going to explain something that when it comes to options trading, if you're not going to take the time to learn anything else, please take the time to learn about this, and that is how implied volatility works. Implied volatility, in my opinion, is probably the most important variable you can take into consideration when trading options, because it's the reason why options are so different than other derivatives. When you buy an options contract, you're doing it in anticipation of what you think is going to happen in the future. And with that, you have variables like implied volatility, which is basically an opinion of the overall consensus of how much the underlying position is expected to move from now until whenever in the future. So because it's an opinion means that it can be taken advantage of. There's arbitrage. And with that said, I hate seeing people ask, how come I bought a call option and the price of the underlying stock went up, but I lost money? That just shows me that people don't understand implied volatility. Or Vega. The Greeks are extremely important, but really just understanding Vega and implied volatility will do wonders. Vega and implied volatility will actually determine whether or not we want to buy an option or sell an option. So we all know the number one rule of investing is to buy low or sell high. The number one rule when it comes to options trading, buy low implied volatility and sell high implied volatility. Why? Because Vega is how much the option value will change per 1% change of implied volatility. For example, if the implied volatility of a stock increases, then the value of the option will increase, even if the price of the stock hasn't moved yet. So let's say we're going into earnings and then some news comes out and whatever company is expected to have great earnings. The implied volatility of that stock may increase, even though it hasn't jumped in price yet, the value of those options will increase. Higher implied volatility means you're going to pay more in premium. It makes them more valuable, the options contract. Why? Because higher implied volatility means that there's a higher chance of those options ending up in the money. Now, there's a few things I'll go over on how to determine all this. So we want to buy low and sell high. How do we determine if it's high or low? My favorite variable to look at is IV percentile. Now you can look at IV rank. That's up to you. I don't like it. I never got into it. I like IV percentile because IV percentile is telling me the percent of time that implied volatility of the underlying position has been lower than where it's currently at today. So if today IV equals 50% and IV percentile equals, let's say, 20%, that tells me that only 20% of the time has past implied volatility of the underlying been higher than 50%. Now, this is quoted on an annual basis. That means if you see IV of 50%, the underlying stock is expected to move up or down 50% within the next year. Now, why is this important? There's a few things that we got to determine, right? And I'll go over a few examples. But how this works is you have this line. This line is an average. And to get that average, you have all these data points on either side of this line. So this is the average IV of whatever position. It would say XYZ stock. And today, the implied volatility of XYZ is 60%. And the IVP, so the implied volatility percentile, is 70%. So what this means is 70% of this data is below 60% IV, implied volatility. Implied volatility and volatility are mean reverting, which means that at some point in the future, it's going to revert back to its average. So if a stock is normally moving so much, and then all of a sudden, for whatever reason, it's moving a lot more, it's going to go back to moving around its average. That means that if 70% of of implied volatility data from the past is lower than where it's currently at today, then chances are that in the future, it's going to revert back and implied volatility will fall. That means that if you own a put or a call, you're going to lose value based off of Vega. Vega is going to cause the price of your option to go down. Whether or not, if you own a put, if the price of the stock's going down, or if you own a call and the price of the stock's going up, if implied volatility falls, Vega will take value off of that options contract. So you want to enter into a position that puts you on the right side of Vega. The good rule of thumb, if implied volatility is above 50%, you sell. If implied volatility is below 50%, you buy. Because if it's below 50%, let's say it's at like 20% here, again, it's mean reverting, which means that implied volatility would increase. If it increases back up to its mean, then you're going to gain value on the option. So you don't necessarily need price action, but you do need implied volatility action. And you need to utilize implied volatility correctly. You can play the odds of options by just knowing implied volatility and having those basic rules to follow when entering into a trade. You don't want to sell put options when the implied volatility percentage is, at 10%. You do want to sell put options when the implied volatility percentile is at like 90%. And you have things that are called like volatility skew, right? Which it can skew either in favor of calls or puts. A good example would be like AMC or GameStop, where it shoots way up and people don't know how much it's expected to move after that, but they think it's going to move a lot. The premiums were skewed heavily to the call side. And they get closer and closer together, which means, for every $5 strike price, they're probably priced pretty close to $5 apart. There's not a lot of extrinsic value difference, between the strike prices. So for one of my examples, we have XYZ, and the IV is, say, 70%, which means it's pretty high, right? It's expected to move 70% within the next year. The IV percentile is 81%. What do we want to do here? We want to sell premium. Why do we want to sell premium? Because the IV percentile is telling us that it is above average for XYZ, and the option premiums are priced, they're overpriced. The great thing about options is that we can take advantage of time and time decay because you have extrinsic value and intrinsic value. And if we're selling out of the money options, they don't have any intrinsic value. They only have extrinsic value. So we're betting on implied volatility to revert back to its average, and this will fall. Therefore, it will lower the price of the option, and we're going to gain because we're short the position. So now I'm going to leave you with something to look for that maybe you can take advantage of. And that is, if you're like on your trading platform, you can find this. It's different for all of them. But basically, you have what's called the Volatility Smile. So you'll have a graph here. And let's say we're at 100. So XYZ is currently trading at $100 a share. And over here, we're at 90. Hope I'm writing it big enough. And over here, we're at 120. A volatility smile will look something like this. And what this is telling us is this is at the money, because trading at $100 a share. So this is an at the money option. This is basically showing you how much Vega or implied volatility will impact your contract. If it's trading at $100 and you buy an at the money option, it's affected less than a $90 option or a $120 strike, because implied volatility will impact delta. I look at delta as the percent chance that option has to be in the money. If it's a 50 delta, it has a 50% chance of being in the money. If it's a 70 delta, it has a 70% chance of being in the money. So if the 120 strike, which is way out of the money, if that's a 20 delta, it only has a 20% chance of being in the money. If implied volatility goes up, then the value of this contract is going to go up. If implied volatility falls, then the value of this contract is going to fall, but it's going to do so at a more exaggerated amount than it would here at 100. And the same goes for at 90. So some arbitrage you can look for is if you have a volatility smile that may look like this. If it looks like this, it needs to get back up. So you could actually buy this 120 contract, and you would take advantage of this going back to where it's supposed to be, and implied volatility increasing, and the value of that option increasing. So, those are just some things to look for. If you're looking on a chart, you could see that with options, and it's just an arbitrage situation that you could take advantage of. Or if it was inverted, right, you could do the same thing. But so that's just a brief overview of implied volatility. You really need to get to know implied volatility over anything else. That is your starting point. And that's going to help you determine what side of that trade you should take. Should I buy or should I sell? And when to do it. If you have any questions, you can email me. If you like the video, hit like, and don't forget to subscribe. Thank you.